When investors explore multifamily properties for sale in real estate investing USA, they often face one major challenge: understanding what truly makes a property valuable beyond the price tag. On Real Estate Capital and Growth USA, we uncover the essential criteria that help shape informed, long-term investment decisions across America's housing markets. Multifamily properties represent buildings with multiple residential units, from duplexes to large apartment complexes. Across the U.S., these assets serve as key foundations for consistent rental income and long-term portfolio growth. Understanding their structure, variety, and function is the first step toward evaluating their real potential in real estate investing. Before we continue, let's take a moment to note the disclaimer. This content is for informational and educational purposes only. It does not provide financial or legal advice. Always consult with a qualified professional before making real estate investment decisions. Now, let's start with the most influential element that shapes every multifamily decision: location. Location is a core factor. In real estate investing USA, location stands as the foundation that determines both the short-term performance and long-term stability of every multifamily property. A well-chosen area can define consistent occupancy rates, reliable rental income, and overall asset appreciation. Across states like Texas, Florida, and California, multifamily investors evaluate not just what's on the market, but where it stands in relation to economic and community dynamics. Understanding this relationship between geography, accessibility, and livability helps investors identify strong-performing neighborhoods within the vast and diverse landscape of American housing markets. Once the right area is identified, the next question becomes, what's the true condition of the property itself? The geography of demand. In the U.S. multifamily housing market, location influences everything from tenant demographics to rent growth potential. Cities like Dallas, Austin, Orlando, and Tampa have become powerful magnets for population migration, job creation, and new construction projects. These regions often display stable rental demand supported by growing economies and expanding infrastructure. Meanwhile, established hubs such as Los Angeles, New York City, and Chicago continue to attract consistent urban tenants, seeking proximity to workplaces and amenities. Accessibility and connectivity. The value of any multifamily property often rises with accessibility. Proximity to public transportation, business districts, educational institutions, and healthcare centers ensures long-term tenant stability. In metropolitan areas such as Miami, Seattle, and Denver, connectivity plays a critical role in shaping rental demand and tenant retention. Properties close to commuter routes or emerging economic corridors tend to maintain their appeal even during slower market cycles. Livability and community value. Beyond infrastructure, the livability factor defines whether a neighborhood remains desirable. Factors such as local safety, green spaces, walkability, and nearby amenities influence tenant satisfaction and long-term occupancy. Suburban communities in North Carolina, Colorado, and Arizona demonstrate how balanced development enhances quality of life and strengthens property resilience. While data helps identify trends, understanding the human element of community life remains equally vital in evaluating true location potential. Ultimately, location remains the cornerstone of real estate investing USA. Each region, from coastal metropolitan zones to rapidly expanding suburban markets, holds unique investment dynamics driven by population, employment, and livability. Understanding these local indicators forms the foundation of sustainable multifamily strategy, not as a guarantee of profit, but as informed knowledge that supports smarter decisions. As we move forward, the focus shifts from where the property is to what condition it's in. The physical state of a multifamily property reveals its true potential for long-term growth and stability. Property condition and structure. In real estate investing USA, the physical condition and structure of a multifamily property stand as critical indicators of long-term value and reliability. A building's outward beauty can attract attention, but true sustainability lies beneath the surface, in its construction quality, maintenance history, and ability to meet modern living expectations. Whether located in New York City, Dallas, or Phoenix, property evaluations provide more than just visual impressions, they reveal the operational health of the asset. Understanding these physical elements enables investors and professionals to assess performance, management quality, and potential improvement costs, all essential for maintaining durable assets in today's evolving housing market. However, even the most beautiful building won't perform well without consistent market demand. Exterior integrity and maintenance. The exterior of a multifamily property often serves as the first reflection of management quality and durability. Roofs, parking areas, walkways, and siding materials are vital indicators of how well a building has been maintained. In regions with variable climates such as Florida, Illinois, and Colorado, weather resilience plays a major role in long-term sustainability. Consistent maintenance signals proper oversight, while neglected structures may reveal hidden costs or future repair needs. Internal systems and building efficiency. Inside every multifamily asset lies an unseen network: plumbing, electrical systems, HVAC units, and energy infrastructure, all of which determine daily livability and operational efficiency. In cities like Atlanta, Houston, and Seattle, where tenant expectations have evolved, reliable systems reduce maintenance calls and improve long-term occupancy rates. Sustainable technologies, such as energy-efficient lighting and smart thermostats, have also become hallmarks of modern property management practices across the U.S. Age, design, and modern adaptation. Older properties often carry architectural character and historical appeal, but they must also adapt to contemporary living standards. Renovation and retrofitting can bridge the gap between traditional charm and modern safety codes. In states like Massachusetts, California, and North Carolina, updated layouts, durable materials, and improved insulation systems contribute to long-term market competitiveness. Evaluating design evolution and renovation history reveals whether a building can perform effectively in current and future housing conditions. Ultimately, the structural integrity and maintenance history of a multifamily property form the backbone of real estate investing USA. Buildings that combine architectural strength, efficient internal systems, and proactive management demonstrate consistent performance regardless of market fluctuations. Understanding the condition of the asset isn't about predicting returns, it's about evaluating resilience. While some investors may see beauty in design, the most enduring success comes from properties built on solid physical foundations and steady oversight. As we move forward, even the strongest structure depends on something equally important: sustained market demand and tenant stability. Market demand and occupancy. In real estate investing USA, understanding market demand and occupancy patterns forms the foundation for evaluating the true stability of any multifamily property. Beyond structure and location, the real strength of an asset lies in the consistency of its tenants, the people who transform buildings into functioning communities. Cities across the United States, from Austin, Texas, to Charlotte, North Carolina, and Denver, Colorado, exhibit distinct demand trends shaped by employment growth, infrastructure expansion, and demographic shifts. Identifying where population growth meets housing shortage often reveals the areas with lasting rental appeal and balanced occupancy rates. Once occupancy trends are understood, investors often shift focus toward performance indicators that reflect the property's ongoing health. Rental trends and regional behavior. Rental markets in the U.S. display distinct cycles influenced by job creation, lifestyle migration, and local affordability. In metropolitan hubs like Los Angeles, Miami, and Seattle, higher rents reflect strong demand but also increased tenant turnover. Conversely, emerging suburban markets, for instance, San Antonio or Raleigh, maintain steady occupancy rates due to balanced living costs and expanding job corridors. Recognizing these contrasts allows analysts and professionals to better interpret the sustainability of rental income and the potential long-term stability of a multifamily investment. Vacancy rates and employment influence. A low vacancy rate often signals a thriving local economy supported by employment stability and accessible transportation. For example, multifamily units located near business parks, hospitals, or universities typically enjoy consistent tenant interest. While a small percentage of vacancies can indicate normal tenant movement, persistently high vacancies may point to market oversupply or management inefficiencies. Evaluating these data points helps maintain a clear picture of demand sustainability, not as a guarantee, but as a measurable indicator of community and workforce alignment. Demographics and tenant composition. Understanding who occupies multifamily properties reveals valuable insights into long-term rental behavior. In fast-growing regions like Arizona, Nevada, and Georgia, younger professionals and small families dominate rental demand. Meanwhile, in established markets such as Boston or Chicago, stable occupancy often comes from older tenants seeking convenience and proximity to urban centers. These demographic layers contribute to shaping community identity, renewal cycles, and property longevity, ensuring that the property remains adaptable to evolving population needs. Ultimately, market demand and occupancy shape the real performance of every multifamily property in real estate investing USA. Regions with balanced employment opportunities, affordable rental structures, and adaptable demographics tend to maintain consistent tenancy and fewer disruptions in revenue flow. While no model predicts outcomes with certainty, analyzing trends and understanding population behavior allows professionals to anticipate which markets may remain resilient through economic cycles. It's a perspective rooted not in speculation, but in observation and data-driven awareness. As we move forward, the next step shifts from identifying occupancy patterns to evaluating financial performance indicators, the tangible measures that reveal how well a multifamily property truly operates over time. Financial performance indicators. In real estate investing USA, financial performance indicators form the backbone of every investment analysis. They transform numbers into insights, allowing investors to gauge how well a multifamily property sustains itself in competitive U.S. markets such as Dallas, Atlanta, and Miami. These indicators go far beyond rental income. They reveal operational efficiency, management consistency, and the property's ability to remain resilient through changing market cycles. Understanding how income and expenses align is not only essential for accurate valuation, but also for assessing whether a property fits into a sustainable portfolio. It's not about forecasting profits, it's about interpreting trends that reflect performance stability. Beyond current numbers, growth potential is often where a property's future story truly unfolds. Revenue and expense structure. Evaluating financial performance begins with a clear understanding of rental income, operational costs, and maintenance ratios. In competitive U.S. multifamily markets like Austin, Phoenix, and Charlotte, investors examine how each dollar earned compares to expenses that maintain property quality. Metrics such as net operating income, NOI, and expense ratio reveal not profit promises, but operational discipline, an indicator of management efficiency. Diversified income streams. Beyond rent, certain U.S. properties improve stability through alternative revenue channels. Parking fees, laundry services, and pet-friendly amenities often enhance long-term financial consistency. In regions such as Tampa, Denver, and Nashville, this diversification supports a property's resilience during market shifts. These added income sources also reflect changing tenant lifestyles, where convenience, flexibility, and lifestyle integration shape demand for multifamily housing. Performance comparison and evaluation. Analyzing financial performance across different multifamily properties for sale USA involves benchmarking. Comparing occupancy stability, maintenance efficiency, and operational margins allows investors to identify performance gaps and sustainability trends. These insights foster informed decisions based on measurable indicators, not speculation. The focus remains on understanding patterns that ensure long-term performance consistency, not on forecasting individual gains. In essence, analyzing financial performance indicators in real estate investing USA provides clarity on how multifamily properties truly perform. It reflects a property's ability to generate consistent revenue, manage expenses, and remain efficient over time, qualities that define longevity in competitive American real estate markets. Understanding these numbers doesn't predict financial success, but it equips professionals with the ability to interpret performance patterns responsibly. Each metric contributes to a broader view of property health, without assuming outcomes. Growth and appreciation potential. In real estate investing USA, understanding growth and appreciation potential means looking beyond the present value of a property and focusing on the forces shaping its future. Cities such as Austin, Nashville, and Raleigh are perfect examples where job creation, innovation districts, and tech sector growth redefine local housing demand every year. These regional dynamics reflect how real estate doesn't stand still, it grows with the people and the economy that surround it. Growth potential is not limited to what can be seen today, it's found in planned infrastructure, upcoming corporate relocations, and long-term demographic movements. Multifamily properties in economically vibrant regions often mirror the pulse of progress. Recognizing these patterns allows professionals to assess stability and longevity rather than short-term results. Let's summarize the key descriptive elements that guide an informed selection process. Economic and employment drivers. Across the U.S. multifamily property market, local economies powered by technology, healthcare, and logistics continue to shape appreciation potential. Cities such as Seattle, Atlanta, and Denver experience population influxes driven by expanding job markets and startup ecosystems. Employment stability often aligns with housing demand, where more jobs lead to stronger occupancy and rising rental values. It's not a forecast, it's a reflection of economic resilience and how community development fuels real estate sustainability. Infrastructure and urban development. Appreciation often follows infrastructure. In regions like Phoenix, Dallas-Fort Worth, and Miami, large-scale transportation upgrades, highways, and mixed-use urban districts attract sustained residential growth. New transit hubs shorten commutes, making multifamily housing near these routes increasingly desirable. Infrastructure not only connects communities, but also supports long-term valuation consistency by integrating living, working, and leisure spaces into a cohesive urban fabric. Demographics and lifestyle trends. Modern appreciation potential also reflects evolving lifestyles. Younger professionals, remote workers, and eco-conscious households seek communities offering flexibility, walkability, and energy-efficient designs. Cities like Portland, Charlotte, and San Diego showcase how sustainability and lifestyle amenities redefine real estate demand. Multifamily properties that adapt to these preferences become part of broader social transformations, where growth is measured not only in numbers, but in livability and innovation. In conclusion, understanding growth and appreciation potential in real estate investing USA involves observing how cities evolve rather than guessing future prices. Economic expansion, infrastructure innovation, and shifting demographics collectively define a property's ability to appreciate sustainably. Each element interacts within the ecosystem of American urban life, shaping communities that endure and adapt. The key lies in recognizing patterns, not predictions. Growth in multifamily real estate emerges where progress meets planning, and where long-term development aligns with human needs. Such awareness fosters informed perspectives, allowing professionals to evaluate appreciation through the lens of urban evolution, not speculation. In this overview, we explored how location, property condition, market demand, financial performance, and growth potential all interact when evaluating multifamily properties for sale in Real Estate Investing USA. Each of these factors works like a puzzle piece. Together, they reveal the full picture of America's multifamily housing landscape. From thriving metropolitan centers to stable suburban communities, the real estate ecosystem continues to evolve alongside economic and demographic trends across the United States. Understanding these interconnected elements helps develop a more structured and data-driven approach to multifamily evaluation. While this overview focuses on the descriptive and analytical side of property assessment, the journey of learning in Real Estate Investing USA extends far beyond, evolving with new market dynamics and regional developments every year. For those seeking to broaden their knowledge about property selection, operational efficiency, and the shifting patterns of real estate appreciation, future episodes from Real Estate Capital and Growth USA will continue to explore these subjects through an educational and fact-based lens. Thank you for watching.